Imagine this. You are the CEO of a billion-dollar empire. You've conquered markets across the globe. But in China, you're burning $1 billion every year just to stay in the game. Your competitor controls 80% of the market. You are outnumbered, outspent, outsmarted. Now, the world watched as Uber, Silicon Valley's unstoppable giant, was crushed by its local rival. Headlines screamed failure. Investors panicked. The competition laughed. In 2016, Uber made the call. They wanted to wave the white flag and retreat from China. Even worse, just like a traumatic event comes back to haunt you under the shower, a very similar event would happen again in 2018 with Southeast Asia. But in the end, did Uber really lose everything in Asia? Well, far from it. This surrender was a masterstroke, one that made them over $5 billion at the time. And it was also a precursor to many of his strategic moves on the Asian continent. This isn't just a story about winning or losing. It's about playing the game so well that even your defeat becomes your victory. Today we'll tell the story of how Uber turned its catastrophical position in Asia into one of the smartest moves it could have taken in its position. We'll provide a detailed analysis of Uber's approach to market entries in the region, what went well, what went wrong, and how they participated in the evolution of the Asian market overall. Hi, this is Michael from Moonswing. Subscribe, like, follow, comment, all this stuff, and let's go. Alright, just before we start, I wanted to say that there is an already existing video by a brilliant YouTube channel called Polymatter, which provides a very serious deep dive into Uber's market entry into China, and it became a source of inspiration for this video. Link will be down in the description, go see it, it is amazing. Overall, in this video, we will not just limit ourselves to China, we'll have a deeper look at everything that Uber has done in Asia overall. Alright, it started just from a simple idea. Tap a button and get a ride. Founded in 2009, Uber didn't really change the way that we were traveling. We already had vehicles and taxis after all. The concept of using a phone application as an intermediary to replace physical services really sparked a revolution in the digital world, and it really became its own world with Uberization. I remember back in 2013-2014 when I first started my career. As a young consultant, it was impossible to avoid conversations with business leaders or entrepreneurs whose only sole dream was to Uberize their services. By 2014, Uber was present in over 200 cities worldwide, worth over $40 billion, and was outpacing giants like Ford or General Motors at the time. Now let's deep dive into the timeline and approach that Uber took when it came to its Asian market entries. Within 24 months, Uber followed a very aggressive approach. It expanded its activities in the region to a total of 11 countries. It first started in 2013 with Singapore, South Korea, and Taiwan. In 2014, it continued its expansion with Malaysia, India, Philippines, Vietnam, Thailand, China, and Indonesia. And finally, in 2015, Japan. Following its Western model, Uber followed a very similar playbook and had to deal with extremely similar circumstances. They would start in general with the country's major cities and would progressively expand to Tier 2 and Tier 3 cities in these countries. It would also launch very quickly multiple services like UberX, Black and Pool, in order to cater to different socio-economic classes and capture as large as a customer base as possible. Of course, it wouldn't be Uber if we weren't talking about heavy subsidies. Uber spent significantly on rider discounts and driver incentives. These subsidies will allow them to quickly gain market share and compete with local players, attracting drivers to its platforms and offering higher wages per ride to drivers. In China alone, it's estimated that Uber spent over $1 billion in 2015, and about $200 million in Southeast Asia. Now, while Uber in general follows a very standardized approach, it would usually gradually adapt to local markets. With its services, for example, where in India, Uber introduced cash payments. In addition, it also released in multiple countries in the region Uber Moto for motorcycle taxis that would be better suited for the heavy urban areas of Bangkok, Jakarta, or numerous Indian cities. The local adaptation would also be reflected at the tech stack level, as it would integrate with popular local apps such as Baidu Maps in China and spend significant efforts improving its GPS system for local conditions. So this seemed like a great playbook to follow. After all, this had been battle-tested in the West, and why wouldn't it work in Asia? So you might ask, what were the results? Well, information is a bit hard to find, but these would be the commonly accepted figures. In 2016, it's estimated that Uber would control about 20% of market share in China, with its main rival Didi controlling the remaining 80%. In 2018 in Southeast Asia, it's estimated that Uber would control between 20 and 30% of market share across all countries, with less significant results in Indonesia, for example, where it would only rank third behind main rivals of Gojek and Grab. Now, these results would really pale in comparison with other markets around the same time period for Uber. For 2016, for example, Uber self-reported a dominating market share of 84 to 87% in the US market. Dahlia Research shared a similar statistics for the Mexican market. A correct revenue number for the period cannot even be correctly provided, as it's estimated that about 50% of every single ride in China were fraudulent. Yes, over 30,000 fake rides were being taken every day in China in the summer of 2015. And how the hell did this happen? Well, very simple. China scammers are very famous for being quite savvy, and they were no exception when it came to Uber. They exploited Uber's promotional features for new users by creating fake driver and rider accounts, used circuit boards with multiple SIM card slots to simulate fake phones, and took fake rides and split the profits. Uber was spending between 40 and 50 million US dollars a day to attract riders in China, but a large portion of this likely went to waste in fraudulent activities. By end of 2015, Uber had spent between 2.7 and 3.2 billion US dollars in the Southeast Asian and China markets. Now clearly, despite a battle-tested playbook and heavy efforts, things were not going so well for Uber in Asia. So what went wrong? Well, first of all, and not a surprise, as almost every Western market where Uber was growing had faced similar issues, there were regulatory challenges. For example, in licensing and permits. In Hong Kong, Uber drivers were charged for not possessing hire car permits and third-party risk insurance. Singapore's Land Transport Authority implemented new rules requiring hailing apps to register, and drivers would need to have valid taxi drivers' vocational licenses. Tax compliance also became an issue, as in Jakarta, transportation agency raised concerns over Uber's tax payments due to lack of proper permits. Various governments also complained that Uber was shirking its tax liabilities. Safety and insurance also became a growing concern, as Malaysia's Road Transport Department warned that passengers were not covered by insurance when using Uber cars. Concerns over public safety increased after incidents like the alleged rape of a passenger in New Delhi. There were challenges to Uber's classification of drivers as independent contractors rather than employees, similar to issues it faced in other global markets. Uber also made numerous enemies with trade unions. In Japan, for example, in 2016, Japanese union organized a rally calling on the government to restrict Uber-style ride-hailing apps and maintain existing taxi regulations. In Philippines, the National Taxi Operators Association demanded a level playing field, arguing that traditional taxi operators faced stricter regulations and higher operational costs. Overall, unions across Asia raised concern about job security, wage protection, and the potential erosion of labor standards in the transportation sector. They highlighted the lack of benefits like paid vacations, maternity leave, and sick leave for Uber drivers. All these challenges impacted significantly Uber's capacity to develop in the region. Now, competition also was a serious problem for Uber. While in the Western world, Uber appeared as an innovator and a first mover, time had passed before their entry into Asian markets. Local copycats had already emerged. Didi Chuxing and other local Asian competitors like Grab, Gojek, or Ola all had several key advantages over Uber in their respective markets. Didi, as a local Chinese actor, benefited from favorable treatment by the Chinese authority, which was crucial in a heavily regulated market. It also had the time to develop strategic partnerships with major Chinese companies like Alibaba, Tencent, or Baidu, which would provide them with financial backing and technological support. In addition, Didi also had a better understanding of Chinese consumer preferences and cultural nuances, allowing for more effective localization of its services. As well as a first mover, Didi established a significant market share before Uber's entry, making it very difficult for Uber to catch up. Didi also provided a wider range of services catering to various market segments, from the low end to high end. And it had the financial resources to engage in prolonged subsidy war with Uber, matching or exceeding Uber spending. Overall, the story is very similar in Southeast Asia. Local competitors like Grab, Gojek, or Ola were all better suited to adapt to local preferences and payment systems. All of these features which Uber would not have at launch and took time to implement. I think this is around the time also where we should talk about the concept of super apps. Many local competitors of Uber were developing what are called super apps, which would integrate multiple services beyond the traditional ride-hailing features that they started with. This would allow them to increase user engagement and loyalty. For example, Grab and Gojek would offer food delivery or supermarket delivery services alongside insurance or safety features, which Uber was very far from implementing at that point of time. This is actually a strategy that Uber ended up copying from its Asian counterparts and importing to the Western world with features like Uber Eats. Now, these advantages of regulatory navigation, cultural understanding, as well as first mover advantage allowed the local competitors to outmaneuver Uber in many Asian countries. Now, one can only assume that Uber board meetings at that point of time, when came the topic of Asian countries, were not very quiet. Blood was on the wall and it was time to clean up. This would take the shape of a brutal change in strategy for Uber in the region. On August 1st, 2016, Uber announced the sale of its China operations to local rival Didi Chuxing. The deal structure would be as follows. Uber China was valued around $7 billion, while Didi was valued around 28, for a combined total entity worth of $35 billion. Uber and its Chinese investor received a stake of 20% in the merged company. Uber specifically received a 5.89% stake with preferred equity interest, equal to a 17.7% economic interest. Uber China's other investors, including Baidu, received 2.3% economic interest in Didi. Other operational points are worth noting. For example, Uber China would be allowed to remain its own brand with separate operations. Travis Kalanick, as Uber's CEO, would join Didi's board, and likewise, Cheng Wei, Didi CEO, would join Uber's board. It was then planned for Didi to invest $1 billion in Uber's global businesses. Post-merger, Didi took control of Uber China's brand, business, data, and other assets. However, both the Didi and Uber apps continued to operate separately, allowing users to choose which platform they would prefer. Didi also expressed willingness to integrate Uber China's employees into their own workforce. Uber offered its China team a close bonus equivalent to 6 months base salary and 6 months equity vesting to ensure a smooth transition. The merger ended a costly subsidy war between Uber and Didi. It was also the start of a strategy of consolidation and focus on its more profitable regions. Maybe Uber would be capable of saving itself in Southeast Asia. However, the issues wouldn't simply go away. By the next year, Uber changed CEOs. On August 28, 2017, when Dara Khosrowshahi took over as CEO, replacing Travis Kalanick. Now, Kalanick had resigned in June 2017 after a shareholder revolt. Uber was without a CEO for about 2 months before Khosrowshahi took over. Kalanick's departure from Uber in 2017 was primarily driven by a series of scandals and controversies that really damaged the company's reputation and culture. These would include sexual harassment allegations, a toxic workplace environment, and numerous public relation crises. These issues, coupled with the declining market share and pressure from investors, ultimately forced Kalanick to resign as the CEO of Uber, paving the way for new leadership to address Uber's challenges and restore confidence in the company. Khosrowshahi came to Uber from Expedia, where he had been the CEO for 12 years. He was selected by Uber's board after a tense research process that involved multiple candidates. He was then faced with the challenge of restoring Uber's public image and move away from the controversy. He would also have to deal with a broader shift towards profitability and the focus on core markets with a clear line of sight on a planned IPO. More needed to happen on the business side to prepare for it. On March 25, 2018, Uber announced the sale of its Southeast Asian operations to the regional competitor Grab. Dara Khosrowshahi said in an email to Uber's staff about the Grab deal, "One of the potential dangers of our global strategy is that we take on too many battles across too many fronts and with too many competitors. Selling out puts us in a position to compete with real focus and weight in the core markets where we operate, while giving us valuable and growing equity stakes in a number of big and important markets where we don't." In this deal, Uber received a 27.5% stake in Grab. Grab acquired all of Uber's assets and operations in 8 countries. It would simply take over Uber's ride-sharing and food delivery services in the region. Uber CEO joined Grab's board, and Grab committed to expanding its food delivery services across the region. The intense rivalry between Grab and Uber in the region led to a fragmented market with very thin profit margins. By consolidating its operations, both companies aimed to achieve economies of scale and improve profitability. And just as fast as it entered the market, that was it for Uber in most of the continent. It had exited 9 countries and would now only operate in India, Korea, Taiwan, and Japan, losing on the operating field to Didi and Grab. But did all this money invested really go to waste? Let's have a look at the math and the aftermath of these acquisitions from Uber's perspective. Uber's exit from China and Southeast Asia might have been seen as strategic retreats. But in the process, it managed to secure significant stakes in very valuable companies. These stakes represented significant paper gains on Uber's initial investments, although the actual value has fluctuated with the performance of Didi and Grab. Uber's stake in Didi was initially valued at $7 billion, with an initial investment to enter the Chinese market of about $2 billion. This could lead to an estimated $5 billion gain on paper. Uber's stake has been diluted over time from 20% to 12% due to new investments in Didi. In 2021, when Didi went public, its market value was about $68 billion on its first day of trading. Uber's 12.8% stake was then worth an approximate $8.7 billion. In Southeast Asia, Uber received 27.5% of Grab. The value of this stake was not publicly disclosed. However, Grab themselves indicated at that time a valuation of about $6 billion, which would mean that Uber's stake was worth approximately $1.65 billion. And this is compared to an initial investment of about $700 million. At its peak in 2021, Grab listed publicly through its SPAC deal, sharing a valuation of about $39.6 billion. Grab's share had been diluted down to about 17%, which would be worth an approximate $6.3 billion. So at the peak of their value, the total stakes of Uber in both businesses were worth a combined $15 billion, a significant achievement compared to its initial investments of about $3 billion. Now, some would simply say that a 5x ROI over a period of about 10 years is nothing. Now, what would I think? $12 billion. Now, as of most recent information available, things have changed significantly. Market erosions, suspicions of antitrust violations, and regulatory challenges has led both Didi and Grab's valuation to plummet from their 2021 peak. Didi would now be worth about $23 billion, which would mean that Uber's share would be worth approximately $2.85 billion. Now, increasing competition, poor financial results, and growing struggles to make a profit has led Grab's valuation to also plummet down from $39.6 to $20 billion as of today. Overall, Uber's investments in both companies are still worth a combined $5.2 billion, a significantly smaller amount than 2021, but still $5 billion. Now, what of its current strategy on these stakes? Dara Khosrowshahi stated that the company's stake in Didi is not considered strategic. They cited two main reasons for this decision. First of all, Didi is a competitor of Uber, and they've described China as a pretty difficult environment with very little transparency. Uber actually plans to sell many of its non-strategic investments, including its shares in Didi. Regarding Southeast Asia, however, there seemed to be no intention from Uber to sell any of their shares in Grab. Now, it's not just about financial gains. Uber has also benefited in numerous other ways from their shares in both Didi and Grab. In terms of knowledge transfer, Uber gained insight in local operations and strategies from both Grab and Didi, which have been very successful in their respective regions. The company also learned valuable lessons about competing in challenging international markets, particularly in Asia. And now, not necessarily proven, but these stakes would also allow Uber to gain access to Didi and Grab's technological stacks in one way or another, facilitating the development for new features on Uber's app in other markets. Now, this change of strategy also benefited Uber in terms of resource allocation. By exiting direct operations in Southeast Asia and China, Uber was able to redirect resources to more profitable markets where it held a stronger position. These stakes would also allow Uber to keep a presence in these markets without the ongoing operational costs and losses. Now, Uber's board representation in both companies would also allow them to facilitate strategic collaboration and information sharing. This would potentially open them doors for future cooperations in areas like technology development or expansions into new markets. Uber's experiences in China and Southeast Asia offer very valuable lessons for companies willing to expand into new markets in Asia. First of all, there is a clear need to understand local market dynamics. Regulatory environment is key. Companies need to thoroughly research and navigate local regulations. Uber struggled with regulatory barriers in China, while local competitors like Didi were better equipped to handle them. They also made the choice to enter all of these markets without understanding local preferences. Uber's failure to tailor its offering to Chinese consumer preferences, like in-app payments, WeChat Pay, Alipay, really put them at a disadvantage. The approach of Uber to release a standardized product in every country and only later on localize it led to their demise in Asia. Then when it comes to strong partnerships, these are a mandatory. Local alliances are a necessity. Forming strong partnerships with local companies provides crucial market insights and resources. Didi's partnerships with Tencent, for example, and Alibaba gave it a significant edge over Uber. Cultural awareness is also key. You need to develop an understanding of the local culture and their business practices. Uber's global model proved less effective in markets that have very distinct cultural nuances. Southeast Asia is a very fragmented market. Every single Southeast Asian country has different cultures that you need to understand and adapt to. Now, there is also a lesson to learn about sustainable growth strategies there. Success in new markets often require patience and sustained investment. Uber's aggressive spending in China and Southeast Asia led to unsustainable losses. And particularly when it comes to Asia in general, there is a need for an adaptable business model. Be prepared to modify your business model to suit local conditions. Uber's plug-and-play approach really failed to address unique market characteristics. Now, one key thing to understand is your local competition. Don't underestimate the strength of local rivals. Both Didi and Grab proved to be formidable opponents for Uber, to the point that what we consider to be an unbeaten giant, disrupting a century-old industry in the West, crumbled in front of small rivals in the East. There is also one lesson to learn as well in market positioning. Uber's focus on the premium segment in China, for example, really mismatched with its actual service operations. And now, the biggest lesson of all: exit strategies. Sometimes a strategic exit can be more beneficial than continued losses. Uber's decision to sell its operations to local competitors in exchange for equity stakes allowed it to benefit from market growth without even any additional operational costs. It is all about value preservation. When exiting a market, focus on preserving value. Uber secured significant equity in both Didi and Grab. It allowed it to maintain stake in these markets' future growths. These lessons underscore the importance of thorough market research, cultural sensitivity, strategic partnerships, and adaptable business models when expanding into new international markets. Now, hopefully, as a current or an aspiring business leader, these are lessons that you can carry with you and that will guarantee your success in your next market entry endeavors. Alright, well, this will be all for today, and hopefully you've enjoyed the content of the day. Look, don't hesitate to share, subscribe, like, and follow for more. Don't hesitate to tell me what you think about it, and look, this was Michael from Moonswing, signing out now. Have a great day.